Ever wondered about the looming threat of bank bankruptcies? While many people think that banks are the safest space for savings, it's not 100% guaranteed. Why? It's because the realm of finance is so vulnerable that even the banks experience crisis. It might not keep you up at night, but many banks are grappling with substantial outflows and significant losses. Welcome to Nova Society, your source of financial inspiration. Stick around for the financial wisdom that can reshape your future. If we could get 300 likes on this video, that would be absolutely insane because we love making these videos for you. US banks are seeing a lot of money leaving, around $870 billion, which is a huge amount. This has been happening since the Federal Reserve started increasing interest rates in March 2022. In just a year and a half, the banks have lost billions, with an average monthly decrease in deposits of about $73 billion. This is a big deal in the history of the United States, and even the FDIC, or the Federal Deposit Insurance Corporation, has noticed a drop in bank deposits in the second quarter. It's important to note that this is the latest official data, and it's the fifth time in a row that deposits have gone down. People are starting to trust regular banks less. A lot of money being taken out of these banks is a big warning sign. It's making people worried about how the usual banking system works and if there might be a banking crisis. The reasons behind this are unclear. Is it on purpose, or are the people in charge just not doing a good job? We can't say for sure, and it might be a bit of both. So if you thought the banking problems were getting better, unfortunately there's no proof to back up that hopeful idea. In the following years to come, it's predicted that the banking crisis will get worse, mainly because many local banks have a lot of ties to loans for commercial real estate. To prepare for this, medium-sized banks in the US are keeping a lot of extra money in reserve. A Reuters report says that US banks are holding onto a large amount of cash to protect themselves in case the economy slows down. People keep taking money out, and there are stricter rules about having enough money on hand. The noticeable increase in the amount of money that US banks are keeping in reserve signals that they don't expect things to improve anytime soon. Instead, they are getting ready for the worst possible situation. To put it simply, medium-sized banks are quite worried about the chance that many people might want to take their money out simultaneously. So, they're saving up extra money to be ready for these withdrawal requests, or else they could be in danger of running out of money and facing potential financial collapse. The second reason for the larger cash reserves in banks is the increase in consumers failing to make their payments on time. When people start falling behind on their payments, banks end up having to consider those loans as losses. Looking at the data on consumer payments so far, there is a clear increase in this type of situation. Specifically, auto loans and credit cards, the main culprits, with monthly credit card payments being overdue, reaching 8% by the end of the second quarter, according to official data. Auto loan payments being overdue are at 3.8%. Unfortunately, with the restart of student loan payments in October, delinquencies are still on the rise. We've covered two main challenges faced by regional banks: deposit outflows and the growing issue of increasing delinquencies, leading to losses for the lenders. However, a third risk factor, often overlooked, is political. This factor might be part of a broader initiative aiming to reduce the number of banks and encourage more consolidation. The motivation behind this potential move is likely in line with the agenda of organizations like the World Economic Forum. So, the third pressure on small to mid-sized banks comes from government regulations. Against a backdrop of significant economic and geopolitical uncertainties, especially given the escalating situation in Ukraine with little mention of peace prospects and the impact of uncontrolled immigration on societies, banks are anticipating heightened regulatory interventions in response to extreme economic stress and associated risks. The FDIC and other US regulatory bodies have publicly stated their commitment to enforcing more stringent liquidity and capital requirements. Liquidity, in this context, refers to the readily available assets, particularly the cash reserves held by banks. Capital primarily encompasses a bank's assets, specifically the loans recorded on its books. A significant area of concern arises from the substantial amount of unrealized losses currently present on the balance sheets of these banks. To clarify the difference between an unrealized loss and a realized loss, an unrealized loss pertains to a financial security whose value has decreased but has not been sold yet. The loss remains unrealized until the security is sold, at which point it becomes a realized loss. The FDIC is noting a surge in these losses in response to the recent uptick in interest rates, following a decline in the preceding 2 quarters. Unrealized losses on available, for sale and held to maturity securities have climbed to a substantial $558.5 billion, indicating the total unrealized losses currently logged on the books of U.S. financial institutions. This increase in unrealized losses is mainly attributed to higher market interest rates and elevated mortgage rates, causing a general drop in market values for debt during the second quarter. This trend is anticipated to continue as we await the official data for the third quarter. In reaction to these developments, many banks have started selling a portion of these securities at a loss and channeling the proceeds from these sales into their available cash reserve. This action could be interpreted as a sign of urgency within the banking sector. Take Bank of America as an example, a prominent financial institution. They recently disclosed that in the first 2 quarters they engaged in asset sales totaling an impressive $93 billion from the available for sales section of their balance sheet. The proceeds from these asset sales were added to their cash reserves. The bank's primary goal is to actively reduce its risk exposure. In an environment marked by unpredictable market conditions and heightened economic uncertainties, minimizing risk takes precedence. By selling off a significant portion of assets, the bank can strategically redistribute its resources, strengthening its risk management practices. This proactive approach to risk reduction aligns with the bank's broader objective to fortify its financial stability amid the ongoing financial challenges. Bank of America's choice to enhance its cash reserves through the utilization of funds from these asset sales is a strategy to better leverage future financial opportunity. The bank understands the importance of having sufficient liquidity, particularly in a constantly changing economic environment. The capacity to promptly seize emerging investment possibilities, financial ventures, or market changes becomes a priceless asset. Additionally, the built-up cash reserves enable the bank to be well-equipped for unexpected contingencies, thereby strengthening its financial resilience. Their strategic move involves a multidimensional strategy aimed at refining its risk management, boosting financial adaptability, and seizing potential opportunities. By carefully navigating the intricate financial terrain, the bank seeks to maintain its competitive advantage and adhere to its commitment to financial prudence. This strategic choice underscores the adaptive and forward-looking characteristics of financial institutions in a dynamic economic setting. In conclusion, the continuous withdrawals from regional and smaller banks suggest a prolonged challenge, with larger banks possibly facing more substantial outflows than initially predicted. While the titans of the industry may weather the storm with relative ease, the smaller banks are grappling with considerable challenges. Their struggle persists, and the path ahead looks uncertain, contingent on whether the outflows continue to escalate. Delve into personal finance and generational wealth mastery on our channel. Subscribe now for empowering videos to boost your wealth. Don't forget to give us a thumbs up. We really do want your help in reaching 300 likes for this video. Do yourself a favor, please click on the next video for more financial wealth building strategies.